Coming up today, stocks continue to slide. The S&P 500 enters correction territory. Besson tries to calm market nerve. The latest economic data. Gold hits a new record. And are we on the cusp of a black swan event? You don't want to miss this one, guys. Let's go. And welcome back, everybody, as the stock market continues to march lower in this multi-week persistent sell-off day after day. And after seeing a little bounce the last couple of days, once again, it's growth shares being sold off again here today, along with consumer stocks and financials as well, continuing to trade lower. With S&P 500 now officially entering correction territory, that's down 10% from its record closing high. And we've got there quite quickly. In fact, this has been the fifth fastest sell-off. And just looking at the price action in the S&P 500, this is where things can get dangerous. And this is the price action that we can see going into flash crashes. Like I said, it's kind of eerily similar to March 2020 for me. And just how fast the correction has been and the uncoiling with volatility marching higher. And so just looking at sector breadth, pretty much red across the board now, except for utilities still holding up in a bit of a defensive trade. And so, like I said, this is a point where it's kind of make or break. The market can quickly find its bottom here, but this is also the same setup where things just go into a bit of a waterfall and we have that big capitulation day or two. We've still got the VIX term structure and backwardation is getting a little bit more flat though. 25 on the 9-day, just a point lower on the 3-month. And one good sign that fear may be reaching a peak is the put-call ratio in equities, now at 107. That's the highest close we've had since back on the 5th of September, which was on this day back here, looking at the SPY. Did mark a little bit of a short-term low there in the market. And so this chart basically means a lot more people purchased put options on stocks today. And that's kind of similar to really extreme readings in the fear and greed index. Still really low here at 15, and we've been down here for over a week now. Just getting back to the S&P 500, looking at a 5-minute chart, something we haven't seen for a few sessions was some pretty strong buying into the close here. The last 5 minutes of the day, and actually the first 5 minutes of the post-market session, had quite a little bit of a pop there, and that was across the board, looking at the Qs and the Russell 2000 as well. And so we're about halfway through March, 2 weeks left in the month and the quarter. Most likely going to be seeing some big rebalancing. Coming into the market over the next couple of weeks, big portfolios could very well on the whole be buying stock and selling bonds. Yield differentials strongly moved in favor of stocks of late. But stick with me because I'll come back to the charts later on, and I'll show you a few other things going on out there that we need to keep an eye on as well. But like I said, the S&P's just done its 10% correction. Many other stocks underneath the surface have done much more than that. Not only the growth stocks, but also financials as well, getting caught up in all of this. Where they'd been previously trading really strong on the back of expected favorable deregulations for the industry. And Robinhood did just come out a few days ago with their latest stats showing accounts and usage and trading pretty much sitting at all-time highs on their platform and growing. But the market is scared about a slowdown in economic growth. Just looking at the median. S&P 500 stock currently in an 18% drawdown, starting to reach levels from back in 2022. But we also did see it briefly there in a similar scare in October 2023 before quickly rebounding. And just looking back in history, anytime we do get a 10% correction on the S&P, only about a quarter of them continue into a bear market, which is defined when the S&P comes off more than 20% from highs. And just looking back almost over the last 100 years for the S&P, the max intra-year drawdown here in the DD column and the end-of-year total returns. This data was from yesterday, so like I said, the S&P's done over 10% now. And if that max drawdown stays under 15%, just looking back in history, each time the max intra-year drawdown's less than 15%, that generally correlates with good returns for the rest of the year. However, you'll notice whenever we do more than 20% or thereabouts, well, that opens up for a negative year returns. Although not always the case, like we saw in 2020. We had a sharp correction for about 5 weeks, then an even more dramatic bounce and recovery. And so just looking at forward returns, this time going back to 1980. Yesterday we looked back until the early 2000s. And so in the last 45 years, we've had 21 correction of 10% or more. Again, 14 of them resulted in no recession, and 12 months later, we're up more than 10% on average. 7 of them did result in recession. Interestingly, the average return 6 and 12 months later was still positive, but we do have peak bearish sentiment in the market. Now got the lowest bullish reading on the latest AAPL investor sentiment survey and persistently high bearish reading. In fact, the bearish readings have now been above 55% for 3 weeks in a row. And this has only happened one other time in history. That was early March 2009 back here. And that was pretty much the exact low and start of this secular bull market, which some say actually started in 2013 when the S&P 500 broke out to brand new all-time highs. So the question is this time different? Is this peak bearish sentiment going to lead into a bear market, or maybe just a flash crash based on a mass exodus over politically driven investing decisions that may or may not turn out to be correct? Because just keep in mind, just because institutions are buying or selling a lot of something doesn't mean they're always right. In fact, if you look at their returns, most of them can't even keep up with the market. And when they're wrong, they can be wrong in a big way, and that's how we get big reversals in the market. Because there's still plenty of sentiment out there to do with staying away from US stocks. As Europe and Asian markets are significantly outperforming US stocks this year, we're now getting rhetoric like this. People are going to be buying dips that are not dips. Expectation that tariffs and a trade war are going to choke economic growth enough that we're going to go into a recession, and that somehow Europe and Asia will be the safest places to hide out, even though they're the most vulnerable in a global trade war. But what's interesting, just looking at Real Clear Politics polling averages, looking at a bunch of data from around the country, there's actually more Americans now saying the country's going in the right direction than the start of this year. We've seen a significant increase, even though there's been a little flatlining the last couple of weeks. And this seems to go in the face of markets. And that could also be a bit of a divergence between Main Street and Wall Street. Because I guess a lot of people on Main Street wouldn't mind a recession, the stock market coming down, house prices coming down, and especially given the admin seems fine with short-term volatility in the markets now. But like I said, the White House put is still there. It's just a bit further out of the money. We just heard new Treasury Secretary Scott Bessent today coming on to CNBC and reassuring people of the economic outlook, downplaying near-term challenges in the economy from higher tariffs and federal cuts. This comes on the back of his comment last week saying the economy needs a detox, but came out and clarified today he didn't mean to forecast a downturn, but also saying he's not concerned about a little bit of volatility over the past 3 weeks, trying to stay focused on the long term. But like I said, if we're not on the cusp of a bit of a flash crash, capitulation, spike up to VIX 50, the odds are we are approaching a low. Looking back in the last 20 years, typically the S&P 500 can consolidate in Q1, especially after 2 hot years, then find its feet come mid-March, and we get a nice little bump up in Q2, where we can often consolidate in Q3, find another low in October, and get that bullish Q4. But just keep in mind, it's never a perfect time to invest. Wait for everything to be perfect. It's more closer to the top. You can always find a good reason to sell your stocks. Remember, the media's job is to grab your attention, and nothing works better than that than fear, uncertainty, doubt, what they call FUD. But throughout everything the stock market has seen over history, yes, it comes with plenty of short-term volatility, but if you can hold throughout that, you will earn a premium for it. If you can handle your favorite stocks going down 50% from highs and not throwing the towel at the bottom and you hang in there, you will earn a premium for that. Stocks have proven time and time again to be the best asset class over the long term. Now let's move it on to the fundamental drivers of the economy, the macro. Got a few data points today. US weekly jobless claims coming in a bit better than expected. 220,000 Americans filing for unemployment benefits versus the 225,000 economists had forecasted. And just looking at the hard data there, once again, just basing along, could even make a little arguments in a slight downtrend here. Lower highs, lower lows, and just going out to a 3-year chart, it's not really spiking up. We can see back there in mid-23, what got a lot of us, myself included, thinking there was a real chance of a recession in Q2, Q3, and 2023. Where the jobs market showing signs of deterioration, plus the Fed had just done its most rapid rate hiking cycle, in addition to the inverted bond yield curve. However, I think that longly held and accurate indicator has been brought into question now for its longest ever inversion, and may indeed been thrown out of whack due to the events in 2020, not to mention Janet Yellen front-loading the Treasury's debt maturity profile. Could have also played around with that indicator. But anyway, the point is here, the jobs market's not fallen off a cliff. However, a lot of these federal job cuts, as the government gets shrunk down, could indeed play into jobless claims over the coming months for sure. Would be kind of surprised if we didn't get a few bump ups and a bit of noise in this data at least. But we keep an eye on this because this can lead the unemployment rate, which is a big indicator of the health of the economy. When people get laid off, they can't keep going out and doing discretionary spending. We also got some more inflation data today. The producer price index, wholesale inflation coming in better than expected. And this can feed into CPI, the prices producers pay. However, we still have some isolated pockets of inflation. I'm sure many of you are aware the price of eggs being pretty firm, apparently jumping 53% year over year. But like all things commodities, the cure for high prices is high prices. Farmers' job is to maximize their yield from their land. Looking at livestock, agricultural, those that have the flexibility will start growing more of one thing if they can make more of a profit from it. And that's why we quite often see in commodities big price spikes on the upside, but then 6 months, a year later, it's come right down as farmers take advantage of those elevated prices and grow more of that product. And that's kind of what keeps all of our food and produce kind of well priced, because when something gets too cheap, it gets grown less. And just sticking on commodities, we've just had gold cross $3,000 an ounce for the first time just as I speak right now. And there's a look on the chart. The front month contract on COMEX sitting at just over $3,000. And so we've had a bit of soft inflation data of late. Trueflation showing that prices in the real economy economy, tracking in the low mid ones. Gold ripping up like this in the last couple of days, not really a reaction to inflation, but more so a weak dollar, as we've seen a bit of a flight from USD assets. Like I said, big and small institutional investors, global investors, making a bet against the new admin, basically what it comes down to. And I'd say a lot of people are worried about a global trade war and maybe looking to hide out in gold as well. And silver may be just about to catch up, pressing up against 52-week highs here. Needs to take out that $35 an ounce. And just going out to a monthly chart, it's still well off its 2011 highs, but the chart is shaping up for a continued bull run on silver here. And there's a look at the spread of silver versus gold, seeming to find its feet in this big support zone as well. And so you could think of silver as the smaller, more volatile brother of gold, very high beta. And when it rips, it can do so like crazy. And we haven't seen that for quite a few years. Bit of a bounce back there in 2020, but nothing like what we saw back in 2010 and 2011. And for those that don't want to own the underlying precious metal, either physically or indirectly via custodian with an ETF, there's also other ETFs like the Global X Silver Miners. And that gives you exposure to 34 different silver mining stocks from around the world. And just going out to a weekly chart on this, that too's looking pretty good. Could be on the cusp of a new bull move here, and could indeed be a place to kind of hide out and diversify if we continue to get more weakness in growth stocks. Otherwise, believe other commodities are still set up for a good buy the dip opportunity, including uranium. Might be finding support down here. And for those that believe tech might bounce back, some of the biggest names are looking really oversold, even for a swing trade here on Apple. Over 10% below the 50-day VWAP, DSI minus 15, and we do have a bit of bullish seasonality coming into the stock over the next couple of weeks. And anybody who wants to get my seasonality forecast indicator for free, just click the link below this video or head on over to my website, clickcapital.io, and you can get this added to your TradingView account today. And in addition to Apple, another big tech company I think is oversold and probably presents more of a better investment opportunity than a swing trading opportunity in my opinion. Alphabet Google, $162 a share. It's now on a forward PE of 18.61, whilst EBITDA is still expected to grow also 18% next year. So just doing a little math on that, 18.61. Alphabet Google's trading on a forward earnings yield of 5.37%, which I consider pretty good considering the 2-year is at 3.95%, and the US government's tax receipts isn't growing 18% a year like Alphabet's earnings is. And so the big worry with them is that chatbots from other companies are going to eat into their golden goose, search. And whilst there is some valid points there for sure, I'm not ruling them out. I still think search is going to be around for many, many more years. I think they have one of the most prized assets in the world, YouTube, in addition to Android, cloud, Waymo, but they're also making big inroads into AI and robotics and quantum computing. We just heard a big announcement from them yesterday. Gemini Robotics brings AI into the physical world, releasing a dedicated model designed for robotics, an advanced vision language action model, and Gemini Robotics ER, a Gemini model with advanced spatial understanding, as they too are going to play a key role in this future industry. Not to mention Waymo, also going to give Tesla and Uber a run for their money. And so in my opinion, I think Alphabet at $162 a share is good value for a long-term investment. Given its cheap valuation, forward earnings yield over 5%, and they still have big, dominant, high-quality, high-moat businesses, along with having a spot at the table on future industries as well. I also think Uber's still trading at attractive levels for a long-term investment. Forward PE of 29, which could be considered high. However, you've always got to take into context how fast earnings are growing. EBITDA growth next year forecast to come in at 39%, and they've recently gone free cash flow positive with really healthy margins. And we're actually just pulling back to levels similar to when we just got news Bill Ackman took a large stake in the stock. Market cap $145 billion. I expect that to hit $1 trillion by 2035. And I use Uber so much myself for transport and food delivery. You can even get your groceries delivered, hardware, anything now, right on the app. And I got to tell you, it feels a lot better spending thousands of dollars with a company when you own a few shares in them. And so this is another one of my long-term bets that is not too far behind Tesla in my conviction in them. And I think they kind of balance each other out. I think they both can succeed in the future of robo-taxis, and Uber may end up actually buying Tesla robo-taxis to run on their already existing and well-entrenched global network. And I think they're the future of transport, kind of already is. Anything that needs to be moved, Uber can do it better than anyone else. And another one today, Intel, as my regular viewers will remember, part of my thesis for getting into the stock a little over a month ago, in the short term at least, was they're bound to find a new CEO. And when they do, that'll give us a pop-up in the stock, which is exactly what we got today. Jumping over 14% on the appointment of Lip Bu Tan, former CEO of Cadence Design Systems. Plenty of chip industry experience and even served on the the board of Intel. Analysts and the street very much like him, and hopefully he can do a good job and turn around this iconic American company that the country, I would say, needs it to succeed, to help deleverage from China and Taiwan. They're also doing partnerships with other big chip heavyweights, TSM, putting plants in Arizona, Ohio, and looking pretty good here on the chart. Another big green volume candle here today, after it just got really oversold to start the week. And at 102 billion market cap, I think this is still an asymmetric bet on the upside as well. And just before I show you a few more interesting charts, here's a look at the top 10 most valuable unicorns. And those are private companies with valuations over 1 billion. When they do a financing round and raise new capital, they'll sell shares at a certain price, which can allow the market to extrapolate its current value. Canva, online design tool; XAI, competitor Temu, Shane; Stripe, processing online payments; the owner of ChatGPT; the owner of TikTok; and of course, the monster of them all, SpaceX. Can't wait till that eventually comes onto the market, hopefully sooner than later, so us retail investors have an opportunity to get in at under $1 trillion market cap, because in the next 10-20 years, that could very well exceed the market cap of Tesla. With Starlink, not to mention other space services. Sounds crazy, but in a lot of our lifetimes, SpaceX is going to be making money from offering services to Mars and beyond. Now, just getting back into the markets, we do have a little bit of an uncoiling going on there today. High yield bonds, some swift selling. Like I said, this is the point where things can get a little dangerous. We're vulnerable to a flash crash, but this is also the price action we can see approaching lows. We did get a more sharper sell-off even just back in December, and looking back over the last couple of years, we have had similar fear spikes that did find a bottom. I guess the good news is on investment grade corporate bonds did find a bit of a buy the dip there today, but Bitcoin and other cryptos also still on shaky ground. But just this persistent sell-off, I think the algos know the next bad headline is just around the corner. Market really trying to swallow all this tariff news and fears of global trade wars and economic slowdowns. Consumer spending is a little soft at the moment. More and more people are getting worried with the current setup. We can see that in the price action of gold. We got consumer sentiment coming out tomorrow, and next week is OPEX, third Friday of the month, options expiry. And like I said, going into the end of the quarter, we could very well see some rebalancing, and the algos might front run that. And so maybe the last week or two of March, next week and the week after, we could see that bounce and recovery. Then the next question will be, when we inevitably do bounce and recover, is that just going to come up and tap the VWAP and roll over, which would be a bad technical sign? Or are we going to get that really powerful recovery above the 50-day VWAP, pull back, retest, hold, and then continue back up? So like I said, a bit of a crunch time for the market here. Definitely could still have that capitulation, even though we're continuing to get a good bounce after hours as I speak. Still in the dicey zone, volatility up the front higher than out the back. Steamroller is still on the loose, but we're almost looking as bad as it can get, especially on bearish sentiment readings. So that's where I stand at the moment. As always, I'm interested to hear your thoughts. You're welcome to post a comment below this video and let me know what you're thinking. Otherwise, I'll be back this time tomorrow, break down all the action from the last day of trading this week. That's all for today, guys, and I'll see you again this time tomorrow. Cheers.